Hello students and welcome to EPG Pathshala. I am Dr. Shefali Nagpal from Bhagat Phool Singh Mahila Vishwavidyalaya. Today we are going to talk on the module International Trade, Import Procedure in India under the paper International Business Operations. After completing this module, you will be able to understand the meaning of import, the types of import and importers, import and international trade, import procedure, import duties, bills of entry, bills of sight. Import. It is a transaction of goods and services into the jurisdiction of the import country from another country. Import country is the one which purchases goods and services. The purchaser or the person, repeat, the purchaser can be a person, organization, agency, etc. and is called as importer. Export country is the country from where the goods and services are purchased. The seller, that can be a person, organization or agency etc. is called as exporter. Import and export are financial transactions which are critical for any economy. Import and export are the part of the international trade and contributes in the gross domestic product of a nation. Let us now see what is the definition of import. Import consists of transactions in goods and services to a resident of a jurisdiction, such as a nation, from non-residents. The exact definition of imports in national accounts includes and excludes specific borderline cases. A general delimitation of imports in national accounts is given below. An import of a goods occurs when there is a change of ownership from a non-resident to a resident. This does not necessarily imply that the good in question physically crosses the frontier. However, in specific cases, national account impute changes of ownership even though in legal terms no change of ownership takes place. For example, cross-border financial leasing and cross-border deliveries between affiliates of the same enterprise, goods crossing the border for significant processing to order or repair. Also, smuggled goods must be included in the import measurement. Imports of services. It consists of all services rendered by non-resident to resident. In national account, any direct purchases by resident outside the economic territory of a country are recorded as import of services. Therefore, all expenditure by tourists in the economic territory of another country are considered part of the import of services. Also, international flow of illegal services must be included in it. So, in this definition, we have seen what is import of goods and import of services, as the definition of the import includes both the import of goods and services, which is defined as per the national account of our country. Types of import. According to the Central Board of Excise and Custom, Ministry of Finance, India, the import is of 4 types, depending upon the types of goods. First is freely importable. These are the goods which can be freely imported without any requirement of license. Second is canalized imports. These are the import of goods which can be imported only through government specified channels and agencies. Third is licensed imports. These are the goods, as the name suggests, which are restricted and requires license for the purchase. Fourth is prohibited import. These are those types of goods which cannot be imported. Now let us understand why countries import. Those goods and services are not produced in their own country, for example, petroleum, oil, agricultural products. The variety of the goods and services that cannot be produced by one country and its people to meet the requirement. For example, many agricultural products, due to the variation in the climate, cannot be produced at a place. It is costly to produce in the own country as compared to the production or import of such products. The quality of the product is low as compared to the imported product. For example, technology-based product with the latest innovations. Production is less as compared to the demand of the product. Due to the limited resources, no country can claim to be the self-reliant in present time. It is not only import but technical advancement also achieved by the country to get maximum benefits. Import support in improving the standard of living of the people of a country by making the goods produced in every country of the world available. Import of latest technology helps in increasing the production in all parts of the economy. Import is helpful to achieve the goal of producing the product at minimum cost. Import also help in diversifying and expanding the production capacity also. Now let us see what is import and international trade. While calculating the gross domestic product of a country, the difference of export and import is taken into consideration. That is, export minus import. When exports are more than imports, the gross domestic product is higher. And when it is on the reverse side, that is, the import are higher than the export, it is negative. Every nation want exports to be higher than the imports to have higher gross domestic product. The main goods of import during the 2015 are shown in the figure below. These were 34% of the total share was crude oil imports with petroleum crude. Another was gold and silver, which contributes 12% of the total share. Machinery, which contributes toward the 10% of the share. Electronic goods 7%. Pearls, precious and semi-precious jewels contribute to 5%. The major trading countries for import with India during 2015 are China, United Arab Emirates, Saudi Arabia, Switzerland, United States, which contribute 10.7%, 8%, 7%, again 7% with Switzerland and 5% of the total share. There are two basic types of goods that are imported: industrial and consumer goods, intermediate goods and services. There are basically three broad types of importers. Those who are looking for any product around the world to import and sell. Others are looking for the foreign sourcing to get their products at the cheapest price. Another category is using foreign sourcing as a part of their global supply chain. Now let us understand in detail what is the import procedure in India. Import, as we know, is the trade of goods from the foreign country. The government defines its import policy to maintain the balance of trade and increase the gross domestic product of the country, and keep control on imports through the various tariff barriers, statutory requirements, custom duties, and other policies. There are various steps which are taken into consideration for the import procedure. The first is trade inquiry. This is the first stage of any transaction. Similarly, while importing the goods from the foreign country, it is essential to make the trade inquiries so as to avoid the complication at the later stages. It is written request by the importer from the intending buyer or its agent regarding the goods specification, price, quality, time of delivery, quantity required, weight, number, and other similar items, and terms and conditions like mode of payment, currency, method of delivery, packing, and other related terms and conditions of import. The exporters supply the quotations referring the details asked by the importer and other terms and conditions. The second step is procurement of import license and quota. The import trade in India is controlled under the Import and Export Control Act 1947. There are regulations to be followed for the import in any country, and similarly in India, for import, obtaining a prior approval for import is compulsory. Importer has to obtain import certificate and import quota certificate. The government lists the items and quantity to be imported. There are two types of license. One is general license, which allows the import from any country. Another is the specific license, which allow import from specific countries. There are three types of importers for granting of import license. One is established importers, other is actual users, and the third category is registered exporters. That is, those import under any of the export promotion schemes. The application by the intender on the required format for license has to be obtained from the controller of imports. The documents required with the application are receipt of license, fee paid, certificate from chartered accountant of total value of goods to be imported, verification certificate from the income tax. Third is obtaining foreign exchange. After the approval from the government and obtaining the license, importer has to make necessary arrangements of the foreign exchange. Depending upon the terms and conditions of import, if the payment has to be made in foreign currency of the exporter, then importer has to apply to the exchange bank for foreign currency. In India, Reserve Bank is the central bank for issuing the foreign currency. Importer has to submit an application in the prescribed form along with the import license to any exchange bank as per the provisions of Exchange Control Act. The exchange bank then endorses the application after verification to be approved by the RBI. The RBI then sanctions the amount of payment to be released for specific transaction. Next step is placing the indent or order. Importer, after obtaining the license, quota, and foreign exchange, places an order. This order is called as indent. The indent are of three types. One is open indent, closed indent, and third is confirmatory indent. Open indent is the indent in which the necessary specifications of goods like price, etc. are not mentioned in the indent. The exporter has a discretion to complete the formalities at his own end. Whereas in the closed indent, all specifications like quality, quantity of the goods, price, time of delivery, etc., they all are clearly mentioned. Third is confirmatory indent, which is where an order is placed subject to the confirmation by the importer's agent. Fifth is dispatching a letter of credit. After the order is placed, the supplier sent the confirmation letter to the importer. The importer then requests his bank to issue a letter of credit. The letter of credit is a certificate by the importer's bank stating that the payment will be made to the exporter on the production of bill. In international trade, both importer and exporter are not known to each other. The importer and exporter appoint a bank in their country to inquire about the credibility of each other. Importer wants to be sure of the supply of the goods and exporter wants surety of the payment. Thus, the bank acts as an intermediary and assure the transactions by playing a key role in international trade. Letter of credit is the important document which ensures the payment to the exporter. Appointing clearing and forwarding agent. The clearance is specialized job for which importer usually appoint a clearing and forwarding agents. The custom clearance is a legal process which takes time, expenses and efforts at all steps. If the importer wishes, he can appoint a clearing and forwarding agent for the custom clearances. The next step is obtaining necessary documents. After receipt of the letter of credit, the exporter fulfills the order and arranges for the shipment of goods and send advice note to the importer immediately after the shipment of goods. Advice note is the document which contains the information about the shipment of the goods, date of the dispatch, and it also indicates the expected date of receipt of shipment by the importer. The exporter sent the documentary bills which contains all documents like invoice of goods, bills of landing, invoice, certificate of origin, consumer invoice, insurance policy, bill of exchange. This documentary bill is provided to importer's bank having its branch in the foreign country by the exporter for collecting the payment of the bill. The documentary bills are of two types. One is documents against payment. In this, the full payment of the bill is made after submission of documents of title of goods by the exporter to the importer bank. The grace period of 24 hours is permitted in this. The other type of documentary bill is documentary bills against acceptance. The payment is made to the exporter only after the acceptance from the importer. Documents are retained by the importer's bank till the date of maturity. A period of 30 to 90 days is permitted in this type of documentary bill. The other steps is custom formalities and clearing of goods. After obtaining the documents of title of goods, the importer collects his shipment from the port. The importer has two choices, that is immediate clearance and to store under bond and clear later. The following procedure is followed for collection of shipment at the port. First, to obtain endorsement for delivery or delivery order. On arrival of shipment, importer receives endorsement bill from the shipping company. This endorsement bill entitles the importer to take the delivery of goods. Shipping company endorses the bill only after receipt of the freight of goods. Depending upon the terms and condition which has been agreed between the importer and exporter, freight charges are paid to the shipping company by the importer or by the exporter. If the freight charges are paid by the exporter, then importer receives the endorsement bill. If freight charges are to be paid by the importer, then endorsement bill is given on clearance of freight charges by him. Second is obtaining port trust dues receipt. Importer, after receiving the delivery, order has to obtain port trust dues receipt. This receipt is issued by Land and Shipping Dues Office. This office charges for the services of the dock used by the importer. Importer fill 2 copies of application to import form in this office and after payment of the dock charges, receive the port trust dues receipt. Third is bill of entry. Bill of entry is the most important document for import custom clearance. Under the section 46, bill of entry is to be submitted by the importer for the custom clearance. Bill of entry is a document which certifies the value of the goods entering into a country. And this is a form supplied by the custom office and is to be filled in triplicate. This form contains all details regarding the name and address of the importer, packages, number, marks, quantity, value, description of goods, name of the ship, the name of the country from which the goods have been imported, and custom duty payable. It was to be filled within 30 days of the arrival of the goods at the custom location. Under the electronic data interchange, that is EDI, no formal bills of entry has to be submitted. It is recorded electronically. The importer is required to file the cargo declaration for processing of clearance. Bill of entry is of three types. Bill of entry for the home consumption. This is a white color form used when goods are imported and are to be cleared on the payment of full duty. It is commonly called as white bill of entry. The goods imported are of use in India. Second is bill of entry for housing. This is a yellow form, so called as yellow bill entry. Goods are kept in the warehouse where payment of duty under a bond can be taken from there when required after clearing the custom duty. This allows adjournment of the payment of the custom duty till requirement of the goods. It is also called as into-bond bill of entry. Third is bill of entry for ex-bond clearance. It is green paper form. This is used for clearance from warehouse after certain period after the payment of duty. Fourth is bill of sight. When importer does not have sufficient information regarding the goods imported due to the lack of documents or information received from the exporter, then he can submit the bill of sight. Bill of sight contains the information possessed by the importer with the remark that he is not in the position to provide the complete details of the goods. Importer is allowed to open the package in presence of the custom officers so that he can fill the bill of entry form with the required information. The other is to pay custom or import duty. There are three types of imported goods. One, non-dutiable or free goods. Second is goods which are to be sold within the country or which are for home consumption. Third is re-exportable of goods, that is, goods meant for re-export. If the goods are duty-free, no import duty is to be paid at the custom office. Custom authorities will permit the delivery of such goods after usual examination of the goods. But if the goods are liable for duty, the importer has to pay custom or import duty, which may be based on the weight or measurement of goods, called specific duty, or on the value of imported goods at volume duty. The next step is payment to clearing and forwarding agents. Importer has to fulfill lot of formalities which are time consuming. To save his time, importer appoints a clearing agent. These agents charge remuneration for the services. When all formalities are done and after custom clearance, importer make payment to his agent. The 11th step is closing the transactions. The last step of the trade is closing the transaction. After the importer is satisfied with the transaction, it is closed. But if there is any shortfall or importer is not satisfied with the quantity, quality or other things, then he will write to the exporter and settle the matter. In case of damage to the goods during the transit, importer can claim compensation from the insurance company. Types of import duties. There are various types of import duties. One is basic custom duty. It is the standard rates and standard preferential rates of custom duties imposed on the goods imported from the specific countries. Other is additional custom duty. It is also called as countervailing duty or CVD. It is levied on the imported goods which are being produced in India. It is payable only if the imported article is such as, if produced in India, its process of production would amount to manufacture as per the definition in the Central Excise Act 1944. The another type of duty is anti-dumping duty. Anti-dumping duty is levied to protect the domestic businesses. It is imposed on the goods which are purchased below the market price. If government thinks so, it may levy anti-dumping duty on such goods. But 100% EOUs, SEZs or FTZs units are exempted from it. The duty cannot exceed the difference between the market price and price, that is, margin of dumping. The importer in this case is notified for the period of 5 years, extended up to 10 years. Another type of duty is protective duty. It is a duty levied to protect the domestic market from imports. The government decides the period, types of goods on which it has to be levied on the recommendation of Tariff Commission. Next is safeguard duty. It is a duty imposed on the goods to protect the domestic markets from exports of products. Due to the heavy exports, if domestic market suffers, then government may impose this duty for 4 years or may extend it for 10 years. Education cess. In addition to the custom duty, education cess of 2% and higher education cess of 1% of the aggregate custom duties is levied. It is being charged to fund health and education initiatives. To regulate import and export in the desired direction, it is very essential that government frame some rules and regulations for export as well as for imports. A developing country like India has to import many goods like capital goods, modern technology, and other essential items from various countries of the world. For making payment of these essential imports and export have to be promoted so as to maintain balance between export and import as conveyed by Levy in 2005 in his book. If imports are more than the exports, then the need for the foreign debt will arrive, which is not desirable for any economy. So students, let us now summarize what we have learnt in this module. Import is critical component if international trade and affect the gross domestic product of an economy. The various types of goods can be imported from the foreign country by following a procedure laid down by the government of any country. In India, it is governed by the Import and Export Control Act 1947. Obtaining the import license is a mandatory condition for the import, and importer requires various types of documents like letter of credit, bills of exchange, custom clearance, and has to pay various types of import duty such as basic custom duty, protected duties, additional duties before closing the specific import transactions. Thank you.